Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about a topic that I think is probably the most important learning process that any investor needs to take in order to become successful at trading or becoming profitable at trading. I think a lot of retail investors go through what I consider a fairly frustrating experience of learning how to trade options. And we're going to go through what some of that learning experience is going to entail and talk a little bit about, me working as a market strategist for the past 15 years, the type of frustrations and struggles that I see a lot of retail traders face, and the behaviors that I see as a result of the trading losses that some clients have and how they go about dealing with it. And I specifically want to point out, just from my experience of doing this for the past 15 years, what I've noticed is different between successful or profitable traders from everyone else. And a large number of investors do struggle with trading. And the unfortunate part from my perspective is the fact that many investors that struggle with trading, they many times blame their strategy, they blame their indicators, but what they don't really realize is that it really has nothing to do with their strategy or their indicators or who they follow. It really comes down to risk management. And that's why I want to spend the time here today not talking about any specific strategies, but just talking about risk management and how to think about it and how to shift your thought process on risk management for your portfolio to hopefully help you become a more successful trader. So let's go ahead and get started. Now, before I do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we're going to start off by talking a little bit about trading psychology. We're going to talk about trading psychology from, again, the perspective of this is the most important part, in my opinion, that defines successful traders from everyone else. Many investors, when they're starting out, they think that successful traders have some kind of secret sauce or some kind of special indicator that you are not having access to, or someone's trying to charge you $5,000 for some kind of trading system, and that's what you need to buy in order to be successful. What I have found is that it's rarely your system or your trading strategy or your indicators that define whether you're successful or not. It's how you manage risk and how you think about your portfolio from a risk management perspective that defines successful traders from everyone else. So I'm going to kind of frame this up in a different perspective. And I think that's the perspective that a lot of investors need to learn, as to how to shift your mentality from this perspective. Once you make that mental shift, the process to actually doing this is quite simple, but it is a large structural shift in the way you think about your investments, the way you think about your portfolio, and the way you think about each individual trade. And once you understand the shift in psychology that you need, that's when we can start taking a look at what are the rules that you can utilize to help you stick to that risk management. And we're going to talk about the golden rule of risk management, which is once you learn it, it's really easy. The hard part is sticking to it. The hard part is having the discipline to use it day in and day out. The process itself is actually really straightforward. Then what we'll do is we'll take a look at linear versus exponential functions, because you need to understand that a little bit to better understand the next few things that we're going to go over, which is, how does an account blow up actually happen, so that we can talk about how to avoid that account blow up. We want to talk about consecutive losses, something that I see a lot of beginner traders don't really account for the appropriate number of consecutive losses. And this is actually what leads to a lot of unsuccessful trading is investors believing that they need to be right all the time in order to be profitable. So every time you have a string of losers, you start jumping ship. You look for new strategies. You look for new people to follow. You look for new indicators. And that is also, a reason for why a lot of investors struggle, is because they don't recognize the fact that no matter what strategy you use, there's going to be some point in your trading career where you're going to have a fairly large number of consecutive losses, and you better have the risk managements in place to account for that and be able to overcome that. Many investors risk too much so that the second they have 5 or 6 losing trades in a row, they've blown up a significant portion of their account. And that is really the downfall of most retail investors. And at the very end, we'll open this up for Q&A. So let's go ahead and get started. But the primary thing that I want everyone to be able to walk away from this particular webinar is an understanding as to what actually sets professional traders, meaning traders who trade for a living and their sole source of income comes from trading. What sets those investors apart from everyone else when it comes to their trading? That's what I want to help investors better understand here today. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. I have been a market strategist for the past 15 plus years, and I have worked with thousands of retail and institutional investors. So I have seen, I would argue, almost every single possible strategy indicator under the sun. And again, what I've noticed is that what sets professional traders apart from everyone else, it's not their indicators, it's not their trading system, it's not who they follow. It's how they go about managing risk and how they think about the risk in their portfolios. Most retail investors focus more on how much money can they make and not enough on how much money are they putting at risk. And that is the true difference between a professional trader and everyone else. So in order to understand that, I'm going to point us to what I see a lot in most retail accounts, which is if you look at the trade P&L of most retail traders, and if any of you can relate to this, please type 1 into the chat window, where you have a series of small wins, small losers. Most of your trades ends up into a small winner or a small loser. And then once in a while, you blow this huge hole in your account where you have this huge loss. So the blue line are the separate individual trades. The green line is your account equity. Your account equity kind of grows a little bit, declines a little, grows a little, declines a little, grows a little bit at a slower pace. And you feel like you're finally making a little bit of progress until one really bad trade or one trade blows a huge hole in your portfolio. And then you end up going back to the same thing, series small wins, small losers, and then occasionally you have these big losses to the downside that blow a hole in your account. If you can associate with that, or if you have done that in the past in your trading account, or if you struggle with this today, please type 1 into the chat window. And don't be afraid to say it if because I know this is not particularly a fun thing to admit or a fun exercise to go through of admitting kind of your losses or some of the challenges that you have with trading, but this is the reality. And I want to make sure everyone understands that you're not alone when you're going through this. And Cheryl said something, that we as traders call tuition. We call these types of trades that where you blow up huge holes in your account, we call it tuition because you're effectively paying to learn a lesson. And I hope that at the very least, what we can do is show you what the right lesson is to learn from this so that you can move on and hopefully help avoid doing that in the future. Now, the one characteristic from this that I get from looking at accounts that suffer from this type of loss is that when you have these large losses, this does not have anything to do with your strategy, which indicators you use. It all comes down to risk management. Because if it really was a poor trading system, a poor indicator, you're following the wrong people, then you wouldn't have consistent small winners with one huge loss. What you would have is more consistent losses to the downside. If you have just more consistent losses and all you have a bunch of losers, then I would say, okay, maybe your strategy, maybe your indicators, maybe who you're following is a little bit off and you want to search for something new. But when you have fairly normal trading with some winners, some losers, some winners, some losers, followed by one large loss that blows a huge hole in your account. What that tells me is that that has nothing to do with your strategy. It has to do with how you manage risk. And to further understand how we find ourselves in this particular situation, this is the type of, I think, pattern that I recognize in a lot of investors that fall under this type of category, which is, here's an example of a trade. You have a stock that maybe bounced off a support level multiple times. So when you get to a support level again, you say to yourself, okay, we're at a support. I'm going to go long the stock, hoping that it's going to reach its previous resistance, maybe in this 31, 32 area. So you go long the stock. And what happens after you go long? Instead of, maybe it moves a little bit higher, but after that, it starts to move lower here. So this is really where I think a lot of retail investors who struggle with trading versus professional investors will diverge in terms of how they go about handling this. I see a lot of retail traders who have an attachment to being right, or an attachment to winning. And this stems from the fact that a lot of retail investors feel that if they simply win more often, or if they win, if they never lose, that they will be profitable. And ironically, it's in the pursuit of winning, and it's in the pursuit of trying to be right on every single trade that actually causes most of us to experience those huge losses in our portfolio. Because what happens is, you get into a trade, the trade doesn't work out, and what you do is, instead of saying, okay, that trade didn't work out, and close out that trade and move on, what you do is you do something else that is, from a professional's perspective, a little bit strange. And that is, look for new justifications for staying in that trade, and adding more to that trade to hopefully get yourself back to break even a little bit quicker. And this is probably by far the most frequent question that I receive as a market strategist. People email me all the time telling me, hey, I bought this stock, or I got into this options position. It's not working out. What can I do? As if somehow there was some magic bullet that if you could just do, that would instantly remove losses from your portfolio, or losses from that trade. The reality is that that doesn't exist. Anything that you do, people ask me, can you roll this position? Can you adjust this position? Can you do this? Can you do that? The answer is yes, you can do all of those things. But the problem is that most of those things involve taking on more risk. So I'm just using a simple example here. I'm not talking about options, but I think most of us can relate to this in some way, shape, or form, especially for those of us that trade stocks. Is a trade doesn't go in your direction that you expect it to, and you start looking for new justifications as to how can you perhaps buy a little bit more, add a little bit more risk, and hopefully get yourself back to break even a little quicker. So at this point, now that the stock has gone against us, instead of saying, okay, let me cut my losses and move on, what we might do instead is say, okay, the $26 support level didn't hold, but there's some support down here around 22. So maybe I could buy a little bit more at 22. So if the stock bounces back up to 24 or 25, I'll break even and I'll get out of this trade. How many of you have found yourself in a position like this and have executed a trade like that, where a trade went south, decided to buy a little bit more, hoping to get yourself back to break even? If you've done this before, please type 2 into your chat window. And sometimes that works, and you feel great, and you feel like a genius. You're saying to yourself, look, I stopped myself from losing $100. Now I'm back to break even. So maybe it works once, maybe it works twice, but many times what happens is, instead of that happening, the stock reverses even further. Now you're in a much bigger hole, because not only did you miss the first opportunity, you missed the second opportunity. And depending on how much you risk on that first and second trade, some investors have already risked a little bit too much, where at this point they feel almost pot committed to this trade. And many investors do this, where they buy a stock and they will never sell unless they get back to break even. And they'll do all types of crazy things to get back to break even, and find new justifications as to why they should continue to buy the stock. By the time it gets down to 18, you're looking at other completely different things from the first reason that you get into the trade. People start looking at indicators and they say, oh, this stock is so oversold, let me buy a little bit more, and hoping that it's going to continue moving higher and getting back to break even. But instead, the stock moves lower. So from my perspective, I've seen this over and over again, where someone buys the first time, second time, the third time doesn't work out, fourth time still doesn't work out, and they get really desperate and start throwing Hail Marys, and the stock keeps going lower and lower and lower. And it's this type of behavior that causes these types of large losses in our portfolio. From my perspective, that has nothing to do with your strategy. It only has to do with how you manage risk and how you think about risk in your portfolio. Because from my perspective, an investor that does this over and over again is someone who just hasn't learned the lesson of what is most important to your trading career? Is it being right that's more important, or is it managing your risk and making sure that you never blow big holes in your account more important? And I can tell you, the person who makes a decision to buy once, twice, 3 times, 4 times, 5 times, that person's not thinking about their risk management of their portfolio. They're more concerned about being right. They're more concerned about winning. And it's, again, ironic how it's actually in the pursuit of winning, in the pursuit of quote unquote trying to be right all the time, that is what brings most traders down and blows huge holes in your portfolio and prevents you from being profitable and successful as a trader. So how can you fix this? How can you change your mentality? This is really where I turn to a book written by an author called James P. Cars. And he wrote a book in 1986 called Infinite versus Finite Games. And when you look at this, James P. Cars was not a finance professional. He wasn't a trader. He had nothing to do with finance. He was a religious philosopher, yet he wrote this book that I think is profound in terms of how we go about viewing not just trading, but a lot of other things in our lives. Whether you are a leader in the organization that you work for, whether you are running a business, I think there are a lot of insights to be gained from this particular book, because this book talks a little bit about the different types of games that we play and being able to identify correctly what games are we playing, because that is very important in helping us decide what's more important to us, what's our main objective. And that's one of the things that I think is what truly sets successful traders apart from everyone else, is they understand what is the right game that they're playing. Most retail investors that I feel are playing the wrong game. And the reason I say that is because of the type of questions that I get from investors. People ask me all the time, how do I repair a losing trade? And what this tells me is that they're not concerned about managing risk. They're more concerned about winning. They're more concerned about being right. And that is the wrong thing to focus on. How do I make my money back on a losing trade? As if that's more important than managing risk. It's not. Lastly, I get a lot of questions from saying, you've had 3 losing trades in a row. Your service sucks. And what this tells me is that this person, again, is more focused on winning and not thinking about the long-term game. And this is really why we turn to infinite versus finite games. So let's first talk about this. So in this book, James talks about 2 types of games. He theorizes there's 2 types of games. And many of you that have ever read game theory, you're familiar with this concept. And he defines that there's 2 types of games, finite games and infinite games. Finite games are the type of games that you and I are all familiar with. These are games that have defined players and observers, meaning you know who's playing. There are fixed rules to the game in terms of what you can and cannot do within the game. The finite games also ends at a certain point, and at that certain point at which the game ends, there's the declared winner and declared a loser. Now, when you play a finite game, there's only one outcome that you're achieving, or one outcome that you're gunning for, and that's to win. So examples of finite games are ones that we're all familiar with, like basketball, football, blackjack, where there is a set rule to the game, and within those bounds of those rules, our goal as a player in this game is to win at all cost. Okay? Now, these are games that we're all familiar with. On the flip side, James says there's another type of game. It's called an infinite game. Infinite games are defined, as he says, where there are known and unknown players, meaning some players are in the game you know about, but there are also players in this game that you don't know about. There are no agreed upon rules to the game. And what's interesting about infinite games is that they never end. So what that means is that when you have a game that never ends, what are the outcomes, or what are you trying to do in an infinite game? And what he theorized, and which is absolutely true, is that in an infinite game, there's no such thing as a winner or a loser. There are only players and people who drop out, meaning players who have the resources to stay in the game, and then players who no longer have resources to stay in the game that have to drop out and can no longer have the resources to continue playing in the game. Now, when you're an infinite game, your goal is not to win. Your goal is to stay in the game. That's your only goal. I think a good example of an infinite game is like starting a business. When you start a business, there's no such thing as winning. You can't win at running a business. You can either be in business or be pushed out of business because you are no longer competitive enough, or you no longer have the resources to stay in business. So when you're playing an infinite game, your goal is not to win. Your goal is to stay in the game. And this is similar to think about a football game. A football game is a definition of a finite game. But think about the National Football League. That is an infinite game that inside of a finite game, meaning the game of football, there's winners and losers. But as a National Football League, the National Football League cannot win. It cannot lose. It can only be the dominant league in the world, or it can get squeezed out by perhaps another league. Now, the NFL is the dominant league in the world, but there are Canadian football leagues, there are smaller US football leagues, but no one pays a lot of attention to the leagues outside of the football league, the National Football League in the US, perhaps the Canadian Football League in Canada. But aside from that, that's pretty much it. And between NFL and CFL, those two are competing leagues, of which the National Football League is the clear leader. Now, there are plenty of smaller leagues that are struggling to stay in business and struggling to gain traction. But for the most part, the National Football League cannot win. It can only be the dominant league or no longer the dominant league. And guess what? Trading is the exact same thing. When you're trading, each individual trade has a winner or a loser. There's no doubt about that. But if you think about your portfolio, there's no such thing as winning in trading. You can't win as a trader. You can only either have the resources to continue trading, or you've blown up your account and you no longer have the resources to continue trading unless you deposit more money. Now, this is a revelation for a lot of investors, because what this changes is your mindset in terms of what's important. Is it important to win every single trade? Or is the goal to stay in the game? Those are two very different things. And when you optimize for one versus the other, you will find yourself either successful in trading, or you'll find yourself very frustrated as a trader. And this is probably the most difficult thing to wrap your head around. But once you do, the way you think about your trades, the way you think about investments, the way you think about when you're in a losing trade, what do you do with that trade? That is going to change substantially. Does that make sense, everyone? The difference between a finite versus infinite game? Please type 3 into the chat window if the difference between the two makes sense to you. And when you're trading, when you're playing each individual game, what is more important? So when you realize you're playing an infinite game, which is what trading is, your goal is no longer to win. Winning doesn't do you anything. Your only goal as an infinite player is to stay in the game at all costs. And we're going to talk about how to go about doing that. But the first thing to understand is understanding what game you're playing and what you are focused on more than anything else. Because once you realize that there's no such thing as winning, you stop thinking about winning. You start thinking about, how do I stay in the game? So the question for a lot of beginners is, what does staying in the game even mean? Like, what does it mean to stay in the game? And it's very simple. It all comes down to protecting your trading account at all costs, because guess what? There's an infinite amount of money you can make from the markets, but there's a finite amount of money you can lose before you blow up your account. And what you're trying to do is, in order to continue to maintain that potential upside of making money, the only thing you can do to do that is by making sure that you don't blow up your account. Because the second you blow up your account, that opportunity no longer exists unless you deposit more money. So what you're trying to do is make sure that the opportunity to make money in the markets is always there, by making sure that you never blow up your account. Now, once you do that, what you realize is what you have to do in order to not blow up your account. And guess what? The rules for that are really, really simple. The most difficult part from my perspective is sticking to the rules. And this is where professional traders set apart from everyone else. They focus their entire attention on making sure that everything they do allows them to stay within the bounds of the game, so that no matter what happens, they are risking only a set amount of their portfolio, so that no matter what happens, they always have a portion of their portfolio intact to remain an investor in this market or remain in the game. That is the key of what differentiates successful traders from everyone else. So in order to help you better understand how to move in this direction, we're going to show you. It's really, really simple. All you have to do is stick to what we call the golden rule of risk management, which is never risk more than 1 to 2% of your account per trade on each individual trade. So what we have here is a chart of your account value, and you can plug in this into a calculator very easily, whatever your account value is. Now, when I talk about account value, I'm not necessarily referring to your entire portfolio of retirement accounts. I'm talking about the speculative section of your portfolio that you're trading options with. So you could have $1 million retirement portfolio, but maybe you're only allocating $150,000 to options trading or more speculative trading. So for that, you only want to take that 150,000 portion for this exercise. And what you want to do is you want to calculate what's 1 to 2% of that total account value. I tend to find that the larger the account you have, the more you want to stick towards the 1% rule. The smaller the account you have, the more you want to stick towards the 2% rule, simply because with a smaller account, it's harder to trade. So for example, if you have a $5,000 account, it's very hard to find options trades for $50. It's even difficult to find $100 trades, but you can find them. So with smaller accounts, you may lean towards the 2% rule. And then as you get into the $50,000 range, you might want to start leaning towards the 1% rule, because the 1% rule just simply means that you put smaller amounts of money at risk and you can trade more often. But this really comes down to the fact that we're going to go through some math and show you why it's so important to stick to 1 to 2%, and why, once you get into the 3 to 4% range, you get into a dangerous territory where you could be at risk of blowing up a significant portion of your account. Now, there's also another psychological reason to using this type of strategy, and it all comes down to the fact that smaller losses are easier to accept and let go of. So what we tend to find is that many times when investors find themselves in this type of position, and the reason that they even take the second trade to get themselves back to break even, many times it's because on the first trade, they've risked quite a bit of money, that they feel that they can't afford to be wrong on this trade, that you become emotionally attached to a trade because you risk so much money in that trade to begin with. So when you trade small, what we tend to find is that they become a little easier to let go of because it's a small loss. It's not blowing a huge hole in your portfolio. Versus if that first trade, you risk 10% of your portfolio, you're going to have a much tougher time to just say, okay, let me let that go and move on to the next trade. People make, unfortunately, sometimes dumb decisions on risk management because they risk too much money to begin with. Now, again, the goal here is to prevent your account from blowing up. So what I'm going to show you is the math behind why this 1 to 2% rule works in the long run, regardless of what your strategy, what your indicators you use, and who you follow in your trading. So in order to understand a little bit about this 1 to 2% rule, I'm going to have to point us to linear versus exponential functions. Now, before COVID-19, this was not necessarily intuitive for a lot of users, but ever since COVID-19, I think a lot of more people have learned a little bit more about exponential functions and just how they work, because they sneak up on you. And it's the same rule as to how it sneaks up on you when you're trading. An exponential function grows at what looks like almost a snail's pace, or looks at what looks like almost no growth for a long period of time. Just like how in the early days of COVID-19, we saw 1 case a day, 2 cases a day, and we said to ourselves, look at China, they have thousands of cases a day, but we only have 3 or 4 for weeks at a time, and maybe it grows up to 10 or 12, and we think to ourselves, this is nothing, it's just not a big deal, until we realize that it's an exponential function and it grows at a pace that is just mind-boggling as to how we go from 10 cases a day to 1,000 cases a day to 30,000 cases a day in a very short amount of time. This is the power of exponential functions. And guess what? This works for and against your portfolio in many, many ways. So we want to leverage the power of exponential functions for our portfolio from a risk management perspective as well. So In order to understand this, the first thing that we want to learn is the gains that are required to get yourself back to break even after a loss. So what you find is that the amount of gains that you need to get yourself back to break even, that grows at an exponential pace. So if you've blown a 10% a hole in your portfolio, it requires an 11% move to the upside to get yourself back to break even. That's pretty close to 1-to-1, meaning whatever you lose, you have to replace to get yourself back to break even. At 20%, it already grows to 25%. So it's no longer a 1-to-1. You will have to have a significant outperformance after a 20% loss just to get yourself back to break even. And what we tend to find is that once you exceed this 20-25% range, it starts to get to a point where it's almost impossible to get yourself back to break even. After a 30% loss, you need a 43% return just to get back to break even. That's pretty difficult to do, in my opinion, for most investors to have a 43% return. So meaning if you blow a 30% hole in your portfolio, it might take you years to get back to your break-even point. 43% return. That's not something that happens every single year or even every couple of years. Sometimes it might take 3 to 4 years for you to see those types of returns. 40%, 67% return, 50%, 100% return. And what you notice here is that it grows at an exponential pace. At first, it looks like it's not growing at all, but at some point, it just gets to numbers that are completely ridiculous and impossible to get yourself back to break even. So what we generally tend to find is that once you blow a hole beyond 25%, anything beyond 25%, becomes almost impossible to get yourself back to break even. So what we try to do as options traders is to make sure that at any one point, we never ever blow up 25% of our account per trade. 25% of our account ever, because that is the only way that we can sustain a profitable trading strategy in our portfolio. If you find yourself in a position where you've blown 50% of your account in your portfolio, good luck getting yourself back to break even without depositing more money, unless it just takes you a very long time and you're an extremely patient person willing to grind it out to do that. I find that almost impossible to do. So this is the first step in understanding that. So at all costs, what you want to do is to prevent your account from losing more than 25% of its total value at any one point in your trading career. And this is any time. This is including thinking about the 2008 financial crisis, think about the coronavirus sell-off, think about the December 2018 crash. Think about those times. Those are part of your investing history. Did your portfolio suffer a 25% loss during those times? If the answer is yes, then you should think about reevaluating your risk management strategy. If the answer is no, then you're good to go. So does that make sense, everyone? Please type 4 into the chat window if you understand why it's so important for you to never risk more than 25% of your account ever in your portfolio, so that this is the only way to allow you to maintain a profitable position in the long run, or a profitable portfolio in the long run. Okay, perfect. I see a lot of 4s. Next, let's talk about, so how many trades does it take to actually draw down or blow up an account? And again, this grows at an exponential pace. If you risk 10% of your account per trade, you need 10 trades to blow up your entire account, 2 trades to blow up, or 3 trades to get to that 25% threshold. At 9% per trade, you get 11 trades. At 8%, you get 12 trades. At 7%, you get 13 trades, roughly. And what you see is that at first, it really grows at a very slow pace. But as you go further and further down the line, the number of trades that it takes to blow up your entire portfolio starts to increase at an exponential pace. When you risk 2% of your account per trade, you need 50 consecutive trades in a row to blow up your entire account. You need 12.5 trades to get yourself to that 25% threshold. At 1%, you need 100 trades in a row to blow up your account. You need 25 consecutive losing trades at 1% per trade to result in that 25% loss that I'm talking about. 25 consecutive trades. That's a very large number of consecutive losing trades if you were to experience that. I would say that that's pretty rare for someone to have 25 consecutive losing trades? Can it happen? Sure, but very, very rarely. And even if that does happen, you're still staying within those 25% rule that we're referring to before. And that's why it's so important that when you're trading, you stick to these types of numbers, because even here, even 5 to 6%, at 5 to 6%, all you need is 5 losing trades in a row to get yourself to that 25% threshold. At 6 trades, you only need 4 losing trades in a row. And anyone here who's ever traded long enough, I think you'll know that at some point in your trading career, and it doesn't even need to have a month like COVID-19 or a month like December 2018 for you to have 4 to 5 losing trades in a row. And if you're risking 5 to 6% of your account per trade, you're going to find yourself in this position all the time. And it's going to be a difficult hole to dig yourself out of each time that happens. Here, you need somewhere between 12 to 25 losing trades in a row for that to happen. That is going to happen at a much, much rarer frequency for you to have those types of losses in your portfolio. So that's why it's so important to stick to this 1 to 2% rule. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Perfect. Okay, I see a lot of 5. So let's talk a little bit about consecutive losses, because this is the part that I think many investors seem to have a bit of a misconception as to just how many consecutive losses does a good strategy typically have. And the answer is, for most investors, it's substantially higher than you might think. So many investors would typically say that they believe that, you know, when you have 3, 4, 5 losing trades in a row, then you've got a bad strategy and you're doing something wrong. The reality is that that's not true at all. Most of the technical strategies that we backtest have a minimum of 7 to 9 consecutive losing trades in a row for most strategies, meaning even the best technical strategies, there are times where you will have 7 to 9 false signals in a row. That's a tough, and what you need to do is you need to realize that that's the reality of trading, that there are some times where you just have a large number of losers in a row. And if you don't account for that and you don't plan for that, then what you're going to do is you're going to keep blowing 25% holes in your portfolio, and you're going to find yourself continuing to struggle with trading. It has nothing to do with your strategy. You could have a really good and sound strategy in the long run, but still have 7 to 9 consecutive losses in a row. I hear from a lot of investors who will tell me, you know, I've had 4 or 5 losing trades in a row. I must have a really bad strategy. And what they do is they don't take the time to learn more and think about whether this is the, you know, the right path. They just simply move on to the next strategy, hoping that somehow the next strategy miraculously just never has 4 to 5 losing trades in a row, until they find that at some point down the road, that same strategy also has 4 or 5 losing trades in a row. And what I see is this pattern of traders that will keep jumping ship every single time they have a string of losers on a strategy, not realizing that every single strategy is always going to have that. There's no such thing as a strategy that doesn't have a string of consecutive losers. It just does not exist. So what you want to do is you want to, at the very least, plan for having at least 5 to 6 consecutive losses at some point in your trading career. And what that means is that if you risk 2% of your account per trade, and you have 5 consecutive losses in a row, what that means is that you have roughly about a 3% chance of having a 10% portfolio loss. Now, we said that we want to keep our portfolio losses to under 25%. So 10% loss is certainly a perfectly acceptable range to be losing. And this is based on your winning probabilities. I think most investors will find that their options trading strategy will range somewhere between 40% to 60% win ratios, depending on if you're predominantly selling options or if you're predominantly buying options. It will vary. So if you're buying options, you'll have more likelihood of having a higher percentage chance of having large number of losers. If you're selling options, you will have a lower probability. But regardless, what you want to do is you want to make sure that you want to stick within that 25% rule. So if you risk 2% and you have 5 consecutive losing trades, you're still okay. And that's why we use that 2% rule. If you selected 5% of your account that you risk per trade, you're going to find yourself losing 25% of your account fairly frequently, at least probably once every year or 2 years where you're going to have 5 consecutive losses in a row, and you're going to find yourself a pretty big battle to get yourself back to break even again. And if you keep doing that every year, you're going to get yourself into a fairly frustrating experience of trading options. But the one thing I will warn investors is that you can't think of each individual trade separately. And the reason for this is because most of us do not enter trades one at a time. We many times enter multiple trades that all expire on the same expiration date. Many times we even have trades that are very highly correlated to each other. They might be all in the same sector. They might be all long, and they might be all expiring in November. I know a lot of people have positions expiring in November. And what you do need to account for the fact is that you need to distribute your trades across expiration dates, long, short, and sectors. Because if you have 5 long trades that all expire on the same day and they're all long technology, guess what? That doesn't really count as 5 separate trades. That's like risking one very large trade all over again. So you need to make sure that you understand that you're not just looking at each individual trade, you're looking at your portfolio as a whole. And you need to group concentrated positions together, because if you're sticking to the 2% rule, but you have 2 trades that all expire on the same expiration date, and you're accounting for potentially 5 consecutive losses, then now what you have is a 3% chance of a 20% portfolio loss, which is still within the bounds of what we're talking about. But not everyone sticks to that two expiration rule. Sometimes we have 5 positions all expiring on the same expiration date. And I would argue that most of you, if you look at your options portfolio right now, you might find yourself in a position where you have a lot of positions all expiring on the same day. And all it takes is for the markets to move adversely that 1 week, and you could be blowing up a significant portion of your portfolio again. So we see that sometimes if you risk 2%, but you have 5 trades per expiration and you account for 5 consecutive losses, now you have a 3% chance of a 50% portfolio loss. So keep in mind, the number of trades that you have at risk per expiration is another factor that you need to consider when you're figuring out your total portfolio risk. Very important to pay attention to that when you're thinking about your portfolio risk. Now, lastly, you can use stop losses to reduce some of that risk as well. So when we use 2% of our risk per trade and we are accounting for 5 consecutive losses, that is like what we said, a 3% chance of having a 10% portfolio loss. But if you're applying a stop loss to your strategy, now you're risking 2% of your account per trade. But let's say you have 5 consecutive losses, but you use a 50% stop loss in your portfolio. You can reduce your risk this way also, because now you have a 3.13% chance of a 5% portfolio loss. So there are multiple factors to keep in mind here. How much are you putting at risk per expiration cycle, because those need to be grouped together. If you're using take profits or stop losses, you also need to take that into account in terms of how much you truly have at risk. But these are all important metrics to think about when you're thinking about how much total risk you actually have in your portfolio, because the golden rule of risk management helps you per individual trade, but you also have to think about the whole spectrum of the trades that you have out there, even if you're sticking to that 1 to 2% rule for your portfolio. So with that, what this goes back to is the golden rule of risk management. Now that we've learned what it is, we learned why it works and the different math behind how it works and what you need to account for in addition to that 2% rule, let's just go back and review. If let's say you have a $50,000 investment portfolio, meaning $50,000 you have that you're willing to risk for your options trading, to risk 2% of that account per trade is $1,000. So what you want to do is you want to take that $1,000 every single time you place a trade. That should be your max risk of each individual strategy. And using that, that will allow you to calculate the number of contracts. So if you're trading an option strategy with a max risk of $200 per contract, that means you can trade a total of 5 contracts. Now, we have built these tools directly into OptionsPlay. You can use this into your OptionsPlay tool to quickly allow you to look at each individual trade. So let's take a look at, I'm going to use BMO as a quick example just to show you. Let's say I'm trying to buy BMO call options because I think they're going to go higher. As you can see, each option here costs $278 or $258 because this is a debit spread. That's my max risk. What I can use is my the third dot here, which is our risk and investment calculator. Now, what you can do is you can plug in your $1,000, which is the maximum risk that I'm willing to take. That's 2% of my $50,000 portfolio. And when I plug it into OptionsPlay, what it'll show me is that I can buy 3 contracts of the calls or 3 contracts of the call verticals, both of which will have a max risk below my $1,000 maximum. So regardless of what your portfolio size is, what you want to do is make a mental note to yourself what your portfolio size is, what's your max risk per trade, and then what you can do is, so if you have a $100,000 portfolio, what you can do is you can plug your $2,000 number into OptionsPlay, and you'll see that you can trade 7 contracts of the call options or 7 contracts of the debit spreads. So what you want to do is you just want to constantly recalibrate how much you're willing to risk per trade, depending on once you have any type of significant change in your portfolio. So if your portfolio goes from $1,000 to, $100,000 to $120,000, then you want to recalculate what the 2% rule is. You also want to change you want to recalculate every time you make a significant deposit or a significant withdrawal from your portfolio, because that's going to affect your total account size. But regardless of what your max risk is, you can always plug it into OptionsPlay, into the risk and investment calculator. It will calculate it for you and allow you to execute this trade with the appropriate amount of risk for your portfolio. Very, very important rule, not difficult to learn, not difficult to execute. I would argue the most difficult part from my perspective is the discipline that's required so that every single time you place a trade, you stay within your bounds. Successful traders always stay within their bounds. And the second a trade doesn't work, guess what? They say to themselves, I don't want to put more of my portfolio at risk, considering I've already lost some amount of money. Let me cut my losses and place my next trade, because I don't want to blow a huge hole in my portfolio. That is what I, again, find the main difference between successful traders, professional traders that do this for a living, and many retail investors that continue to struggle with options trading. Comes down to this one key aspect in how they view their investment portfolio. Has nothing to do with your strategy, has nothing to do with who you follow, has nothing to do with what indicators you use. I tend to find that more of the successful traders don't have sophisticated strategies. They don't have overly complex strategies, because the more complex it is, the harder it is to stick to the rules. The simpler your rules are, the easier it is for you to stay disciplined and stick to those rules. And that is what sets successful traders apart from everyone else. So with that, that covers what I wanted to share with you here today. Like I said, I covered a lot with you here today, but I would argue this is one of the most important lessons to learn. So if you are still finding yourself in a position where you find yourself struggling to be profitable with trading, I hope that this was insightful in giving you a different perspective into what is the most important thing as a trader. Is it managing your indicators? Is it figuring out how much potential money you can make? And I would answer that those are not important things. The most important thing is knowing how much you have at risk and making sure that those risk numbers never exceed a certain tolerance or never exceed a certain threshold that allows you, from a mathematical perspective, to stay above water and stay profitable. Once you get past the 25% loss in your portfolio, mathematically it becomes extremely difficult to remain positive, remain profitable. And that's why we stay to these rules so heavily, and we pound these rules into investors' mindsets to help you stay above that high water threshold, stay above that high water mark that allows you to at least have the opportunity to be profitable and stay in the markets. Because if you wipe yourself out, guess what? All bets are off. And that's the key to I think what differentiates successful traders from everyone else. So with that, thank you so much for taking the time out here this afternoon. I hope that this was helpful in giving you a better understanding as to the mindset that professional traders and institutional traders typically view investments, not from the perspective of how much money can I make, how much potential upside is there. Their first question is, how much risk is there? Am I taking on too much risk? That's always their first question, and that's what differentiates, I think, retail traders from professional traders. So I hope that this was helpful in giving you a little bit of insights into how professional traders think. At this point, what I'll do is I'll open this up for Q&A. If you have any questions regarding what I showed you here today, feel free to type them into the Q&A window. We have a Q&A window, we have a chat window. Please type your questions into the Q&A window, and I will answer your questions out of there. So Barry's asking, Barry, if you have a specific question about a specific trade, send me an email at info@optionsplay.com. Keep in mind that we're not here to provide personal investment advice. I can only provide you with my personal opinion. Mohammed, hi Tony, my question is on optimal expiration dates for buying call options. If I'm bullish on a stock for the next 30 days, which options expiration day should I select from today? I generally will tell you, for most investors to start about 60 days out when you're buying options. And this is all so that you have an option that has lower time decay and gives you a fair amount of time for the trade to work out. We generally don't want to hold these long options in the last 3 weeks or so. You generally want to roll those trades if they start to go in your favor, or cut losses if they don't work out. Andrew, if I have $10,000, should I not lose more than $100 per trade? Is that correct? So Andrew, the $10,000 means that you can risk up to $200 per trade. That's the most that you generally want to risk. I tend to find that the smaller account you have, the more you end up having to lean towards 2%. So with a $10,000 account, the answer is it's about $200 that you should risk per trade. What about 2% of your increasing portfolio instead of sticking with 2% of the original one? What about 2% of your increasing portfolio? Yeah, so if your portfolio increases, you want to continuously recalculate what 2% is. So if you go from 20,000 to 25,000, then you want to go from risking 400 to 500. If you go from 25 to 50,000, then you go from 500 to 1,000. You constantly want to recalculate based on the changes in your portfolio value. Rai is saying, hi, Tony, would you cut your losses right away if you see your strategy go against the direction you set a timeline, then pull out? Rai, great question. Rai's basically saying, when do you cut your losses? So from my perspective, there's two reasons to cut your losses. Number one, you've risked more than you originally intended to. So if, let's say you normally have a 50% stop loss and it triggers that stop loss, that's a good reason to simply get out of the trade. Then the second reason that you generally want to get out of a trade is if the thesis as to why you got into the trade to begin with is no longer valid. So for example, if I got into this trade because I believe 22 is a support level, and the stock breaks that support level and continues to move lower, then my thesis of why I'm even in the trade is clearly wrong. That should be the reason why I get out, because my original thesis is wrong. That's it. I was wrong, get out. Don't be attached to winning. Don't be attached to being right, because that is what causes investors to blow up their account. When you're too attached to being right or too attached to winning on every single trade. The sooner you can let go and admit the fact that the reason that you got into a trade is no longer valid because there's new information coming out. Maybe you got into a trade because the information that you didn't have information at the time, and there's new information out that changes your mind. That should also be a reason to get out. That's not a good reason to stay in the trade. Tim, you're very welcome. Barry, you're very welcome. David is saying, thank you, Mr. Zhang. I missed this class. Possible to listen to the recorded version of that class? Yes, David, all of our classes are recorded. We give you the slides along with it. We usually send it out about an hour after we finish each day. What to read markets going into US election? Better to avoid options trading for this period? What's your view on wheat stocks versus Democrats lead? So a lot of questions in that. So generally speaking, I think a lot of investors are positioned going into the election. Everyone has different views as to what you believe the outcome of the election is going to look like. Generally speaking, you have two possible front runner outcomes. Number one, you have Biden winning, as the polls currently show, and then the Democratic sweep of both Congress and the Senate. That will likely lead to a larger stimulus bill, that will likely lead to higher taxes, that will likely lead to potentially the legalization of weed. And then if you look at the other possible outcome, which is Biden winning, but having a split government where you have a Republican controlled Senate, but a Democratic controlled Congress, that is likely going to lead to the most, I would say, concerning views of the markets, because that is likely to have further, I would say, fighting for a large stimulus bill. That is unlikely to lead to weed legalization. It could potentially also be a painful transfer of power. If Trump wins, or if Trump wins, either there's a Democratic sweep or a split government. I think the lack of a contested election will likely be a positive for the markets. So a lot to unpack there in your question, but I think a lot of investors have different views and are expressing those views currently, utilizing options, especially with volatility at fairly elevated periods. A lot of people are selling volatility going into the election. How do we calculate risk for cover calls and credit spreads? So covered puts. So covered puts is really similar to buying the stock, right? So what we do is we look at the 2 standard deviation move and what your total risk there is, and that's how we calculate the number of shares. So you can use that to calculate approximately the number of contracts to sell. So as you can see here, Bank of Montreal, we're saying that you can buy $195 and stay within the $2,000 rule, or $2,000 risk. How do we achieve that? What we basically said is that if the stock made a 2 standard deviation move around that, you would experience about a $2,000 loss. So for that, you can trade 195 shares. Then you would sell 2 contracts, roughly 2 contracts of a cash secured put, because 2 contracts is roughly 200 shares. And even if the stock makes a 2 standard deviation move to the downside, you're here in this particular case risking about 2% of your portfolio. In the example of a credit spread has a max risk, and our portfolio, our risk and investment calculator will calculate that appropriately. So let's say I sell this credit spread that has a risk of $120 per contract. When I type in $2,000 in terms of risk, it'll tell me that the appropriate number of credit spreads to sell is 16 contracts, which will bring my max risk again just shy of that $2,000 number that you're looking for. So that's how you would utilize it for cash secured puts as well as credit spreads. Hi, Tony. Thanks for your awesome efforts. Is next week on Monday at 12 or same time as today? I have to look at the schedule. I'm not 100% sure. I think next Monday might actually be at noon, but I'd have to check the schedule. You can look on Zoom. It'll show you what the next session is going to be timed at. Tony, is this the comeback expectations we have seen before that makes us stay on? I'm not sure what you mean by comeback expectations as to makes you stay on. Stay on what, Norm? If you don't mind answering, I'm happy to help answer that question. What is it when you buy long? I'm not sure what you mean by that question. Long just simply means that you're buying the asset. Short means you've short sold the asset. How do you scan for good opportunities? So Tony, that depends on what you mean by good opportunities. Depends on what type of strategies you're typically doing, if you're doing cover calls or cash secured puts. So OptionsPlay has a lot of different opportunity reports to help you scan for opportunities, whether you're looking to speculate on a bullish bearish idea using our trade ideas section, whether you're using our watch list. We have cover call and short put reports for those of you looking to generate income. It really just depends on what type of trading strategy you're most used to, or the type of risk profile you're looking for, and then I can help point you in the right direction. Bruce, great info. Infinite versus finite game theory is so important. I completely agree, and I highly recommend for those of you that want to learn more about this, just Google infinite versus finite games. There are so many applications to your life outside of trading for this very theory. It applies to running a business, it applies to your marriage, it applies to anything that is truly an infinite game where there's no such thing as winning. And many times, in some of these ventures, we do think of them as winning or losing. We think of us, as running kind of a business that's better than someone else, or we're winning versus someone else, or when we have a fight in our marriage and we think about winning versus losing. And you think about this, it's like, there's no such thing as winning in your marriage. You can either be married or no longer married. And once you've realized that, you start changing the way you perceive and the way you go about so the challenges that you have with running a business and marriage and trading. So I highly recommend for those of you that are interested in this concept to explore a little bit more, because you might find that learning how this applies to other aspects of your life helps you apply it to trading as well. I mean, tickers that potentially go your way, which indicators? So Tony, we recently did a study on technical analysis. So I'm happy to share with you, some of the findings on that. But the reality is that, most indicators give you a small edge in terms of trading, but there's no one indicator that just consistently makes you money. What consistently makes you money is how you manage risk. It's not about your indicators, because you could have the best indicators in the world. If you don't follow what I just taught you here today, I guarantee you will blow up your account at some point in your trading career. So focus more on that than your indicators. Once you feel that you've got your risk management dialed in, I would argue it doesn't matter which indicator you use, whether you use RSI, MACD, stochastics, CCI. We've shown empirically the different indicators all have relatively the same performance. One does not clearly outperform the other. There are some nuanced difference between the different indicators. Some have slightly higher performance, some have slightly higher consecutive losing trades, but overall, they all work. You just have to first have a strong risk management system in place before you can apply these strategies systematically to your portfolio. However, given that Trump is likely to lose but contest the election in days, should we stay out? So, the chances of a contested election is what is likely going to drive a lot of volatility for this markets. That's one of the concerns that we have about November 3rd, is that, let's say Biden wins, but there's a contested election and it has to go to the courts, and there's not a peaceful transfer of power, and this could drag on for weeks, perhaps months in a legal court case. That is probably the worst case outcome for this election. If you're concerned about that, then I certainly think that you either stay out of the market or you have options positions that are suitable for that type of volatility. Should I recalculate my risk amount every single time I place a trade? No, I don't think so. I think you only recalculate your trades when you have a significant change in your portfolio. So when your portfolio value changes by more than 10%, I think that is usually a good time to recalculate your risks per trade. When the PRIMS value go down, you hope it'll rebound back with time left. I'm not sure what PRIMS value, PRMS value goes down means, Norm, if you don't mind clarifying. Right, an option I bought is close to being at the money and I still have a few days left. Will you wait till expiration date? So whenever you're buying an option, you should never hold it to expiration, because in the last few days of expiration, you are experiencing a high amount of time decay. You generally want to roll that out to maybe the next 60-day option if you want to hold on to that trade. This way, each day you hold on to it, you're experiencing smaller amounts of time decay, or relatively smaller amounts of time decay than an option that expires next week. Ash is saying, does the risk management strategy only apply to options or stocks as well? So it applies to stocks as well, but generally speaking, you would expand that range a little bit more, because your risk of losing 100% of your stock investment is much, much lower than risking 100% of your options investment. Whether you're buying a call option or selling a credit spread, your chances of losing 100% of that trade is substantially higher in an option trade than when you're buying a stock, because the stock has to go all the way to zero for that to happen, and that doesn't happen very often. So the rules still apply, but when you're buying a stock, you might want to risk no more than 5% of your account per trade on a stock trade, rather than 2% that you might apply for an options trade. But the same rules apply, just the thresholds are different. Hi, Tony. Do you recommend that we set up a bracket order for stop loss and take profit? For example, cut losses at 50% and take profits at 80%. Jessica, I would say that if your broker supports that, absolutely. I use bracket orders for almost all of my options trades. When I get into a trade, I immediately have a bracket order set in place. so that even if I'm not looking at that trade, I know that I'm protected on both sides, either at a stop loss on or take profit. So absolutely, I encourage you to use bracket orders for all strategies that you trade, whether you're trading stocks, futures, currencies, options. If your broker supports it, utilize it. It's a useful tool. Mohammed is saying, thank you, Tony, for the presentation. Is there a particular broker you can recommend for options trading in Canada? So, Mohammed, I will say that, for most Canadian investors, the one thing that I've heard a lot from Canadian investors is lack of multi-leg execution and high commissions that many investors complain about in Canada. So the one firm that I can point you to that I know is lower cost and offers multi-leg execution is Interactive Brokers. They are one of the few brokerage firms that offers per contract pricing without a fixed price per leg. That can potentially reduce your costs, especially if you're trading a couple of contracts. It can reduce your commissions from, 12, 13 bucks down to $2-3. They offer multi-leg execution up to 4 legs on all US and Canadian equities. So regardless of which ones you're trading, you're able to trade multi-leg options. I think that is probably, in my opinion, one of the best values for Canadian investors. What do you think about options trading on 3 times leverage ETFs? I mean, I don't know what to say in terms of what you expect me to say. You obviously are seeking a high amount of leverage. If you understand the risks with doing so, go ahead. I don't think that that's an appropriate amount of risk for most investors to take on that kind of leverage, because most of the times you're already leveraged 10 to 15 times on your option position. If you're adding another 3x leverage to that, that means you're leveraged 45 to perhaps 60 times. Is that a recipe for disaster in the long run? All it takes is a few losing trades and you can blow up your account significantly. So be careful with that. As long as you understand the risk, you're okay with that. So it looks like next week, one of the questions was, what time is the session next week? It is at 12 noon. Thank you, Prasad. To roll my position, does that mean offset my current position, then do the same thing to my current position, like long put all the way? So rolling is just very simple. A lot of people get confused by a roll. A roll is just closing your current position and opening up a new one, usually in a later dated expiration date, as the same order. So if your broker doesn't support multi-leg execution, you can't do it. You can only do it if your broker supports multi-leg execution. That allows you to close and open a new trade at the same time in a single order. That's all a roll is. That's it. What is the refresh rate for quotes at OptionsPlay? The quotes are delayed by 15 minutes, but every single time you refresh, you'll get the most up-to-date delayed quote on OptionsPlay. Is it a good idea to buy XFN call expiring June 2021 $34 strike? So I don't know what your thesis as to why you want to go long XFN. That's up to you. I can't speak for why you're bullish on XFN, but I certainly think a $34 strike option is a, if you're really bullish on XFN, buying a June $34 strike option is a perfectly reasonable long-term option to purchase on XFN if you're bullish. The only thing to remember is that just to say you're bullish is not enough, because you're paying 59 cents, or I'm sorry, if you go out to June, you're paying $2.12. Your break-even price is $36.12. You have to ask yourself, do I think XFN will be above $36.12 by June expiration? If the answer is no, you shouldn't buy this call option because you're going to lose money. If you think the stock's going to be well above 36 by June, then it does make sense to buy this call option. That's how you need to decide whether this is the right investment for you. Sorry, what I meant is that the losses might reduce or bounce back. That what keeps us not to react. Norm, I'm not sure I understand your whole question here. When something goes down, you hope to rebound it when it goes back. So there's nothing wrong with holding on position and waiting for it to rebound, as long as the original position is within your risk parameters. So if you risk 2% on that trade, then you're okay, even if the stock goes all the way to, even if the trade goes all the way down to zero, because when it goes down to zero, you've risked 2%. That's a range that you're comfortable with. So when you keep within your risk tolerance, waiting for a stock to bounce back is perfectly reasonable and perfectly normal to do, and perfectly acceptable from a risk perspective. But if you risk 10% of your account per trade and the stocks and the trade's down 7%, do you want to wait for that to bounce back? I would argue that no, because you've already exceeded your risk tolerance. On expiration date, when is the cutoff time to sell if my option is in the money and would I like to offset that? Right. I usually say that, especially on the expiration date, especially if something is in the money, don't wait until the last. I would cut out that trade before noon. After 12 o'clock at noontime, you're going to perhaps have a tougher time to be able to close out that position. So don't wait until options expiration. Okay, with that covers all of the questions that I can answer here today. I really appreciate everyone for taking the time out here this afternoon. I really hope that this was helpful in giving you a better understanding as to how to utilize options for your portfolio, and specifically around risk management and how to make sure that you maintain the correct risk management for your portfolio to remain successful as a trader. Thank you so much. I hope you have a great evening, and I'll see you guys here next Monday here at noon for our live market analysis section, where we're going to take what we've learned and start applying it to the real markets to give you a better understanding as to how to utilize what we've learned using real examples. Thank you so much. Have a great evening, and I'll see you guys next week.